So lay out for us how investors should be thinking about this relationship between oil and equities. Lower oil prices, higher dollar. Earlier today, a guest was saying that that's a great setup for the Fed to continue in a gradual way. How should we look at it?
I think it's confusing because there's so many things going on. I think the major factor in this sell-off has been psychological. It's a bearish sentiment that set in. The market had been overextended. It was very long. We were at the time that Brent was hitting $86+ a barrel. We had the longest ratio between longs and shorts in the history of the market. So that was bound to sell off. And now we've gone to a very short position based on a whole bunch of bearish news. I don't think it's risk on, risk off with equities. I think the commodity markets and oil in particular are acting on its own. And I think it's in for a bounce in the short run. We still have a ways to go into the wintertime. We still need to count the amount of Iranian barrels that are off the market. And I think we'll be seeing inventory draws before the fourth quarter is over. So the sell-off got us back to reality. And then I think it oversold the market a substantial amount. We have a lot of things happening in the next few weeks, including an OPEC meeting, a meeting between OPEC and non-OPEC countries, including Saudi Arabia and Russia. They'll all have market impacts, but I think on the whole, the lows are here for a while. That's not to say we won't see lower prices by the end of next year.
So, Ed, if it's psychological, how much of this should we attribute to U.S. action? I mean, between how much we're pumping here domestically, between President Trump saying that he wanted Saudi Arabia to keep supply high, and then the Iranian sanctions not turning out to be what some expected. How much of that might be short term, just the market adjusting to what the U.S. has done?
No, I think a lot of it is short term. At least $5 of the price swing is short term. So yes, I think that the Saudis and the Russians put a lot more oil in the market. They made the same mistake in the fall that they made in July. They put this additional oil in the Atlantic basin. It affected the structure of Brent when Brent was very tight and the market was in backwardation. The market looked strong, and then this uplift in new production mostly went into the Atlantic basin and it weakened it. So it created a psychological mood by the way it was done. I think the market, in terms of producers, were disappointed in the waivers that were granted. So I think the American actions in that sense were misleading. So between the overproduction and what happened with the waivers, I think that's most of the price action. But there's a lot of oil coming out of the United States as well. So not by presidential design necessarily, but by market. We're seeing U.S. production now growing annualized at a 2 million barrel a day rate, far in excess of global demand. So we have to look closely the next couple of months at what the final data are for U.S. domestic production.